Who do I speak to first? Should I speak with my accountant who will help me decide whether I should buy this property in a trust or whether I should go to a mortgage broker who will help me decide first? Now, a lot of times my friends tell me that their accountant is saying something and their broker is saying something else.
I've got ChatGPT on my side. But relying on ChatGPT, it's not a mistake. It's a disaster waiting to be happen.
And everyone's just saying that the trust lending is not happening anymore. The banks are not doing trust lending anymore.
So the trust lending is definitely happening.
Now the million dollar question.
Go for it.
What about negative gearing? Because if I buy in a trust, I will not be able to claim negative gearing.
That's a very, very important aspect, and a lot of people get drowned into thinking like negative gearing is the only thing they can achieve out of property.
Hi, this is Harkirat from ClearTax. Today I'm representing myself as an average property investor in Australia. Now, just as any property investor, I have a lot of questions in my head. The first one being, who do I speak to first? I have so many professionals around myself, so many professionals you need to buy one property. But most of all, I've been thinking about this for days. Who would I speak with first? Should I speak with my accountant who will help me decide whether I should buy this property in a trust or a self-managed super fund or my individual name or a company, or whether I should go to a mortgage broker who'll help me decide first? So I did the better thing. I got both of the boys in one frame. So I have...
I am Paritosh Vatwani from APW Finance.
And this is Yuvraj here from ClearTax.
Awesome. So I got both the accountant and the broker in one frame, so I can ask the questions that goes on in my head, and probably you are the one thinking about the similar questions right now. So question number one, Yuvraj, this is for you.
Right.
So
Okay.
when should I think about buying a property in my personal name?
Right, okay, very interesting. Before we go there, whenever anybody comes to us, we always ask them, what do you want to achieve out of it, right? So what are your goals? In the long run, are you looking to protect your assets? Are you looking to leverage your assets? Are you looking to reduce your tax? So the answer depends on that, whether you should go for an individual name, family trust, or unit trust, SMSFs, or a company.
Thank you so much, Yuvraj. Now, a lot of times my friends tell me that their accountant is saying something and their broker is saying something else. So the same question to you, Paritosh.
Before you want to accelerate your property portfolio journey, you got to make a team. You got to get the trusted accountant, the accountant you can trust and you trust his advice, and the broker you can trust to hold your hand and grow your property portfolio. Under which structure you should buy the property, obviously is more to do what are your long-term goals. So there's not I cannot give you the same answer for every particular client. It's not a mundane thing. But if you really want me to say, then generally people buy PPOR property under their personal name, most of the time, bearing some doctors and solicitors to protect their asset. But again, the answer will really depend on a specific situation, and I think Yuvraj will agree with me, right?
Yeah, that's 100% right. See, a lot of times I've seen people coming to us and they say, my friend has bought a property in individual name. Now he's got 5 properties. Should I do the same? So the answer to that is very simple. There's no cookie cutter approach applies to everyone. We need to assess your situation and what are you really looking and achieve out of those things, So based on that, we guide and advise. This is the structure you should go for. This is aligning with your goals.
Thank you so much, guys. I think the really good takeaway from this is going to be that it's not a one-person job. You need an advisory board around you where you need a broker and an accountant on the same table, probably.
It's just a team effort, It's always about, getting the right team on your side. A lot of people think, oh, I know everything. I've got ChatGPT on my side. But, relying on ChatGPT, it's not a mistake. It's a disaster waiting to be happen. So you need to really think that, that are you taking the right advice and following the guidelines as shown by the professional, or you going with the route which is not really, taking you anywhere.
Thank you so much, Yuvraj. And when should I think about buying one in a trust, for example?
I think if you want to accelerate your property journey and if you want to have more than say 5 or 3 properties, depending on your income as well, but let's say if you want to have more than 5 properties, I think you should start your property journey under the trust from the first investment property, not the PPOR, but the first investment property. And then you got to be really careful what type of asset you are buying. it has to be positive and things like that we can talk. But yeah, the first property should be under the trust or under the company if you are looking to accelerate it. If you are someone who just want one PPOR and one or two investment, then you can do under your personal name as well. That's what I think. Yuvraj, you want to
Yeah, of course. See, again, it depends what you want to achieve out of it. Lending perspective, yes, you can go for the family trust. For example, if you want to keep on borrowing and buy more assets, but then there are other aspects as well. Very important. First one is asset protection, tax saving, estate planning. So you need to look into where do you fit in those pockets and what do you want to achieve out of these things. So that's how you decide, and that's how we guide the clients as well. Okay, this fits structure and this will help you to achieve your goal in this period of time frame.
Thank you so much. So I heard something really interesting, that as Paritosh said, that the first property itself should be in a trust. The thing is that a lot of these property discussions are happening over family dinners, over barbecues, and what I commonly hear is just buy your first one in your personal name and test the waters and see how you go with the second one. Probably second one or the last one should be in a trust. But Paritosh, you said something different. So would you explain on that, as you said that the first one itself should be in a trust?
So I got a call from the client few days back, and they were on a decent income. So the family income was close to $160,000, $100,000 for the male applicant, and $80,000 or $60,000 for the female applicant. They had a PPR property in Melbourne. The loan was only like $400,000. They had around $500,000 sitting in the offset account, and they want to buy 5 properties in next 3 to 4 years, including 1 or 2 properties under SMSF as well. And they were about to get some inheritance from overseas as well. So with them, if they want to have 5 properties, that's what their goal is, and the long-term goal is to have a passive income and have a financial freedom. So if they want to buy 5 properties, then for them the advice was that okay, from get-go you got to buy your first investment property under the trust, and then hence and so forth. What type of property you buy, it's a different discussion, but the first property has to be under the trust. If you really want to achieve 5 properties, and then in next 10 years they were planning to sell 1 or 2 properties, pay off the loan, and have a passive income of around $120,000. So for that particular client, that was the advice. But
The
again,
other thing I've noticed a lot of times, the magic word is say negative gearing.
yeah.
I want to buy the property because I can enjoy the benefits of negative gearing. But a lot of people don't think in terms of the long run. Yes, it's fine. You'll save some money by spending $1. You may get 30 cents back. How amazing it is. You need to spend $1 just to get 30 cents back. That's not really wise. So if you want to achieve something in the long run and save the tax along the line as well, so it's better to buy in a structure which allows you the flexibility of tax planning. So trust is one of those structures where there are a lot of possibilities to reduce your taxes in the long run, because see, with the time your income goes up, so is your tax rate. So you might be sitting in the higher tax bracket, and if the property is sitting in your personal name, guess what? When you're going to sell it, what's going to happen, you think? They're going to pay the tax at the higher rate. Do you want to do that? Not really. So if you got a trust in place, at least I've got a vehicle where I can fix my tax rate.
Thank you, Raj. Just for the viewers, for better understanding, is it possible for you to share an example that would be easy to understand?
Okay, let's take a very simple example. Husband, wife, and they got 2 kids above 18 years old. And now both of them earning, let's say, 190,000 each, husband, wife. So they are both sitting at 47% tax bracket. Now, let's say the property is positively geared property. If the property is owned between husband and wife, which is normally what do you do when you buy as an individual, the taxation on that rental income is going to be at the highest tax rate, 47%. So if you earn 10,000 income, you're going to lose 4,700 out of it. But now the wiser choice is, if the property is sitting in a family trust, you distribute that 10K to any kid and you pay, guess what? Zero. Zero tax. How amazing is that? The key is the planning, because you thought about it and you really planned for the long run, that what's going to happen. Let's do some cash flow projections that, what if my income goes up this way? What if the rental income goes this side? What I'm going to do? The trust is giving you that flexibility where I can sit down, plan, and reduce my taxation, and that's legal as well.
Thanks, Yuvraj. So,
Can I add one more
yeah,
question to
please.
Yuvraj? Yuvraj, the same principle will apply when you sell a property. So let's say you sell a property, there's a profit of say $100,000 to make life simple,
Yeah.
and then you get a 50% CGT
100%,
discount.
yes.
So 50,000, and you can distribute to your kids,
Yes,
to your
that's right.
father, mother if they live with
Yeah,
you, or
yeah,
whoever you want to
Yeah.
distribute to.
So any Australian tax resident within your family group, you can distribute the income. They'll do get the 50% CGT discount because it's sitting in a family trust. And then based on that, you can distribute that 50,000 within the family members. Let's say, you got 3 people who are not earning any income at all. So if you cut that 50,000 and distribute that income, you end up paying 0 tax on that 50,000.
Wow.
Otherwise, you may end up paying half of that to the taxman.
So just to summarize these two, what we've discussed is that tax planning gets easier with a family trust. So if your property is anticipated to make a profitable rental income in the future, you have an avenue to distribute that profit or the rental profit in the future with the eligible family members as beneficiaries in the trust, hence saving you tax. Another thing that we discussed is if you plan to sell the property in the future, then you can also possibly save capital gains, maybe pay less capital gains tax by the same distribution factor. But Yuvraj, what if I've decided not to sell the property and I want to keep it really long term and pass it on to my kids or the next generation?
See, the trust is really useful vehicle in this scenario because all you need to do is the property is still sitting in a family trust, owned by the same structure. So you've never sold the asset, so there's no capital gain tax event happening, which means no taxation liability. And now passing on it to the next generation, all you need to do is give them control by adding them as a directors, for example, to the trustee company.
Okay.
So basically they are controlling that asset and decide what to do with the income in there without any capital gain tax event happening. So that's quite possible. Again, the key, as I said, it's do the planning first and then buy the asset, not the other way around. Because a lot of times, client comes to us, big problem, I've got a $500,000 capital gain, what should I do? And then I say, my hands are up, only God can help you, not me. Not me, right? So I mean, if that person has come to me before they bought the asset, the situation could have been very, very different.
And that does happen a lot of times where we see clients.
It does happen a lot because people see, as you see what's happening around you, that's how you make decisions. But again, have a professional on your side, get a guidance, get a advice, because there's no other way around it. It's as simple as that.
So what we have learned so far is that there are usually 3 things that people do with their property. Either they keep the property to generate rental income, or they would sell the property in the future to realize gains, or they would keep it even longer to create generational wealth. So far, in the situation where if you want to do one of these 3 and you need to plan in advance, probably the trust is winning so far. But now this is the biggest question I had in my head. So, and this is for you, Paritosh.
Yep.
That even though a lot of my friends, a lot of clients that we deal with understand that trust could be a better option going forward, but the news say otherwise. And everyone's just saying that the trust lending is not happening anymore. The banks are not doing trust lending anymore. So where do we go from here? What is your take on it?
So the trust lending is definitely happening. Yes, the banks are making sure that they are being responsible lenders. They are doing the loan as per the NCCP. They are making sure that they are not giving more loan to a family. They are not giving more loan to a person and they cannot afford, and they fall back on their repayment. So the trust loan is definitely happening. All the major banks have changed the way they want to do the assessment. So CBA is very much active in the trust lending. NEB is active. ANZ, St. George, Westpac, all are really, really active in the trust lending, and they are option for second tier as well. So second tier banks, including Pepper, Brighton, and all these people are doing the trust lending. But the really important thing is that you got to go to an experienced broker, and he or she can guide you on how to do, which bank to go first and which bank to go for your second, third, fourth, fifth or sixth property, because there's a sequencing you got to do it. Some banks will ignore the trust lending in the other, even though it's a positive geared or not, and some banks will not. So you got to be really, really careful that you are going to a person or you are going to a broker who is experienced in that field and can sequence the bank based on your circumstances. And main thing, everything is based on your long-term goals, not what you want to achieve in 6 months or 1 year, what you want to achieve in next 5 to 10 years. We got to plan today. Otherwise, it's too late. So trust lending is alive. Yes, banks are making sure that they are doing it in a more responsible manner, which I think is really good for everyone, all the investors out there. That's what you want, that banks are doing it in a responsible manner.
Thank you so much, Paritosh. That really clears up a lot of things for us. But now, what if it stops? Because more and more banks are pulling out of trust lending. We hear every week, every month. So what if I get a loan in the trust now, and in the future, let's say 2 years, 3 years, 5 years down the line, none of the banks are doing trust lending anymore? Do you think, obviously nobody can predict the future, but does it worry you? Does it keep you up at night as well?
Not really, not really. I genuinely think that the trust lending will become more and more responsible, where the onus will fall on the borrower, the broker, and the accountant to make sure that the customer did got the right advice on day one. But I don't see trust lending going away, because if you see, all the business lending is happening under the trust, under the company, and people have multiple business under different entities. So the structure or the way it is happening is still the same. Instead of buying business, people are buying properties, which is generating the income. So will the trust lending go away? I don't know. Will it become more and more responsible, where the onus is on the broker and the accountant? Yes. And we got to be careful. We have to be really careful in giving the right advice. If the customer walks into the door, the job is not to give them a loan. The job is to make them understand what are the consequences, what are the cash flow projections, and how will they manage that cash flow, not now, for the next 10 years. And if the answer is yes, they can easily manage the cash flow, then yeah, trust lending is a great tool for them to create a generational wealth. I don't think it's going to go away, but again, who can predict? No one.
That's very true. Yeah, I mean, again, the bank has increased their risk assessment,
Yep.
and the scrutiny has gone up. But it's a good thing overall for the market as well. Comparing, giving loans where people in the long run cannot afford them, then eventually you might have to sell those assets. Might not be into a really great situation. So overall, if you look at it in the long run, that yes, you may not be able to have portfolio of massive properties, but at the end of the day, it's the asset portfolio you got, it's manageable.
Yeah.
So we can agree that only change is constant, but is it going to stop the investors? Probably not.
No.
This one is for you, Yuvraj. So if I do end up decide to buy in a trust, what are the things that I should really be aware of?
Right, okay, so these few things, first of all, again, before deciding on that this is the right structure, you need to understand what's important for you. Whether I need to protect my assets, whether I need to reduce my taxes, whether I need to ensure I'm in the right vehicle for lending purposes, and then whether I want to pass on the asset to the next generation. So you need to think along all those lines and find out what's important for you, and based on that you need to decide that's okay, this structure fits me, right? And then you need to understand the tax implication and other things about the trust, in terms of that who's trustee of the trust, who are the beneficiaries, how the system works, what you're allowed to do, what you're not allowed to do. So you need to understand the whole things around it in order to ensure that yes, it fits within the criteria I'm looking for.
Thank you so much. And so would there be any circumstances where you would not recommend somebody to have a property in a trust?
I mean, there's a lot of time we've seen, let's say if you're a single, for example, and you don't have any other family, for example, then probably, again, depending on what you want to achieve out of it, trust might not be a suitable structure. You might not have a massive goals of achieving a portfolio of massive properties. So in those kind of scenarios, probably trust might not be a suitable structure.
Thank you so much, Yuvraj. Same question to you, Paritosh.
Who
In
will
what
you not
circumstances would you not recommend somebody borrowing in a trust?
So before I talk about trust, I make sure that the customer can afford the cash flow. And if they cannot, if they have a plan where the wife might go on a maternity leave and will not come back to work for next 3-4 years, they want to, spend more time with the kids. So I just tell them that make sure you are doing the cash flow projections really well. This is what I think your cash flow will be. Talk to the accountant though, because they can give you more of accounting advice. I cannot, but I don't see that it will help you in long run. It can put you in a financial problem where you might lose that property, will give you financial stress. Financial stress can bring families apart as well. So as long as the cash flow is not making sense, I don't really advise them to go for it. Someone on an income of say 60 or 70K buying multiple properties might not be the best thing today. So be very careful. Or someone buying the PPOR, I won't recommend to buy under the trust as well, unless they have a legal advice or they have got the accountant advice and they are in a certain professions.
Thank you so much. So I feel like these professionals are doing the right thing. They're asking all the smart questions. What are the other questions that you feel like, Yuvraj, this is for you, that people are not asking themselves, where you jump in and ask them the right questions to kind of help them decide and make an informed decision?
See, a lot of time people really don't think about that if they're going into a different structure, what or why they are going into those structures. So people don't really understand, because a lot of times they've seen what's happening around them. My friend has done it. He's got a trust, I want to buy it under trust.
Or the other way around.
Or the other way around, yeah. Or the other way around. But as I said, it's not a approach where I'm saying, or we are saying that, yes, this is the right structure, you should go and buy everything in a family trust. A lot of time it's not suitable to your circumstances.
Yeah.
So you really need to first of all think and align your goals, that this is what I'm looking for from the structure in the long run, that I want to reduce my tax. At the same time, I want to protect my assets. And that's what decides your strategy. That's how you should go and, look into it.
Thank you so much, Yuvraj. So basically, a person should consider their long-term objectives and reverse engineer the approach based on that. Now, the $1 million question.
Go for it.
I think this is the one that everybody wants to ask. And a lot of you have already heard different versions of it. But let me be very direct and ask it straightforward. What about negative gearing? Because if I buy in a trust, I will not be able to claim negative gearing.
That's a very, very important aspect. And a lot of people get drowned into thinking like negative gearing is the only thing they can achieve out of property. And that's what led them to go maybe to the wrong path of getting savings tax deductions. So again, yes, in the short term, you might have some tax savings by utilizing and reducing your taxable income with the negative gearing. But in the long run, when you sell the property, then what? Do you have a planning tool in place that if you don't, then you will end up paying a higher amount of tax, because you might be owning that property, let's say with your wife. So there's only two people who are sharing 50-50 in that property, and that's how the only way we can split the income. I cannot give it to your any other family member. I cannot put that money into your bucket company, because the decision has already been made in the past, which cannot be overturned. Yes, you probably can look into transferring the property into a trust down the line if it's already bought in a personal name, but really you need to think about numbers first, that what are the implications at that point in time. There might be stamp duty implications, there's capital gain tax, but sometimes people do that depending on their situation, maybe for asset protection reason. That's one of the way people like to go for.
So let's take a simple example here. If someone's buying a property that's expected to be negative for the first, let's say, 5 years, and obviously this is not a very practical example, but just for the sake of convenience of discussing it, let's take very easy and impractical numbers. So let's say that property is anticipated to be negative $10,000 in the first 5 years, $10,000 each. And let's say the couple's earning $100,000 each, so both the spouses are in 30% tax bracket. So they will receive $3,000 in tax returns every year. So if they do end up deciding to buy in a trust, that is $15,000 of tax savings just gone.
That's one way to look at it. But see, yes, you have saved 15,000 for the 5 years. But now, at the end of the 5 years, is your income going to remain at 100K? Most likely no. It may go up to 150K and you fall into a different tax bracket altogether now. And now, let's say after 5 years, the property has turned into a positively geared property, which is highly likely going to be the scenario anyway. You'll end up paying the tax at a higher amount. And then again, when you sell that asset, then what? You don't have any options. You will keep on paying tax on that at a higher tax rate. But on the other hand, if the property is sitting in a trust, the negative gearing works very differently. But the biggest difference is the timing. Yes, you're not allowed to claim that negative gearing against your income every year, but you're allowed to carry it forward.
So, correct me if I'm wrong, but the way I'm understanding this is that if there's a property that is negative for the first 5 years, yes, you can claim negative gearing and ATO will give you some tax back for the first 5 years. But for the next 5, 10, whatever years when the property is positive, you will claim that income. You will declare that income as a
And
part
pay
of your
tax on it at
taxable
a higher
income.
tax rate. Yeah.
At probably a higher tax rate. So essentially, whatever money ATO paid me in the first 5 years, I will pay everything back and probably will keep on paying more.
As they said, nothing comes for free.
Nothing comes
That's what people believe with the negative gearing, but implications are there in the long run. So now in the same example, you've got a 50,000 loss, which after 5 years, which you can carry forward. But now let's say in year 6, the property is positively geared now. The income you're earning, guess what? You're not paying any tax on that income. Reason being, because you got carry forward losses to utilize. So until you exhaust those losses, you're not going to pay any tax at all for the time being. For next 5 years, probably, let's say if you make 10,000 every year positive out of the property, so no tax for those 5 years.
So hold on. So what you're saying is that the losses or the negative gearing in the trust is not actually lost. You can still claim everything, but instead of claiming it against your personal income, you claim it against the income of the trust whenever it starts, whether it starts in form of rental income, rental profits, or in terms of capital gains.
The other example is, let's say, in year 3, you got a 30,000 loss sitting in there, and at that time, you've decided to invest in stocks as well, for example. And now, given that the market is doing well and you're earning good dividends out of the stock market, that dividend income is taxable. But guess what? We've got losses sitting in the trust, so we're able to offset those losses against that income.
So that's a great tool, right?
Yeah.
So you haven't lost that negative gearing aspect, but it's just a different way of claiming it.
I say it's a timing difference because see, if you look at it, every year once the property is making losses, I'm claiming those against my income every year 1, 2, 3, 4, 5. But now in a trust, you're just carrying it forward and you start claiming it from year 6. So here I'm claiming it every year, but in the trust you start claiming it from year 6. So the key is the timing difference. But see, it's better in a way because see, now you're saving tax at higher rate because if your income goes up, so is your tax rate. Now you're saving at a higher tax rate. But when you were using the negative gearing while having the property in individual name, you might be saving only at 30%.
So that's a big myth busted for me, that what we are implying is that in the long run, the effect of negative gearing that you would have on your personal name versus a trust can actually be same depending on your circumstances. So losses are not lost. So it's basically instant gratification versus delayed gratification, but the gratification is definitely there.
And whenever people go for negative gearing assets, they really need to decide on the other thing as well, that why you're spending $1 to get 30 cents back.
That's true. I have a question for Yuvraj.
Yes.
So Yuvraj, so let's say over the period of 5 or 10 years, we have a loss in a trust for say 10,000, which is accumulated to say 50, just to make life easy, right?
Sure, okay.
And we sell the property at a profit of $100,000.
Right, okay.
After CGT discount of 50%, there's a taxable income of 50K.
Yes.
Will it get, so
You're
can
allowed
we?
to offset those, yes, you're allowed to offset those losses against,
So the
against the income.
capital gain profit can be offsetted against
Yes.
rental income as
That's
well,
right. Yeah,
rental
yeah.
loss as well.
Yes, correct.
Okay.
Yeah,
Okay.
yeah.
So that's a
Only
big
when-
advantage,
sorry,
right?
No, only when you sell the asset, you can offset those losses sitting in the trust against the capital gain.
Okay.
Yes.
So basically the losses in the trust can be offset against the profit, whether that profit is coming from the rental income or whether it is coming from the capital gains. Is that correct?
Yeah, yeah.
Excellent.
That's right.
Amazing. So thank you so much, Yuvraj, for explaining so many benefits, and for Paritosh for giving us confidence that the trust lending is definitely happening. That is one answer that we really, really needed. Another aspect of trust is land tax, probably.
Yep.
That I feel is not talked about enough. So, just in summary, Yuvraj, for our viewers that are not very tax savvy, how would you talk about land tax in a trust?
See, land tax again, it's a very and crucial part of your planning process as well, because some states are really levying heavy land taxes. So again, deciding factor is a lot of structures get taxed differently given depending on the state you are in. For example, in New South Wales, going with the family trust, you end up paying massive amount of land tax. But if you go with the unit trust, you will get the available threshold. And same goes for different states. So again, the key is you need to ensure that you plan for it accordingly, because it's a state-based tax which is getting implicated on different structures at a different threshold.
Thank you so much, Yuvraj. So, Paritosh, for somebody in situation like this where they're exploring different structures, where they are still talking about their objectives, and they are definitely thinking to buy investment property or properties, hopefully.
Yeah.
Now, should they be speaking with a mortgage broker first or an accountant first?
I think it's a good way. So the way I do it, if they call me first, I said, how about you set up a joint telephone conversation or a joint meeting with the accountant, and we all three can sit down and try to explore the goals, right? The taxation advice has to come from the accountant because we are not licensed and we don't know as much as accountant like Yuvraj will know, right? It's a team effort. If you really want to grow your property portfolio, you got to have a right team with you. And accountant is the key partner in there.
So, the last thing you want is that your accountant and your broker are not talking then.
Yes. They should talk to each other.
100%.
And they should actually, we all are working for a client. We are all there to make sure that the client achieve the goal in a manner which will not put a financial stress on them. That's what we want to do. So definitely, I think it's a good way to talk to each other and get the right advice from the right professional. If it's a legal question, go to the solicitor or the conveyancer. If it's the accountant, mortgage broker.
So, as Yuvraj said in the beginning, that it's not a cookie cutter approach that you can follow. You cannot buy in a trust just because your friend did, and you shouldn't buy in a personal name just because your friend did.
Yes.
So, the idea is to talk to the professionals and then decide and reverse engineer the approach based on your objectives and the final outcome that you want to achieve. Thank you so much, everyone. This is Harkirat from ClearTax along with Yuvraj Verma.
Thank you.
Parvitosh Wadhwani from APW Finance.
Thank you.